Okay, now, couple things that I want to point out first before we go through this. Okay? Since we are looking at a calendar spread, right? Essentially what we have is a calendar spread. Right? We're short an August put spread. We're long a September put spread. Right? Everybody understand that concept? Which is why I highlighted up here the title of this being SPY Calendar Put Spread P&L. Okay, so when we evaluate the value of these options at the August 23rd expiration, which is the expiration of the short put spread, we can't really assess the exact value of the September options because why? Not volatility. Okay, well, what would be, there you go. Barry and John have it, right? The September options will still be holding a lot of time value to them. Okay? Does everybody get that concept before I move on to the next thing I want to say? Exactly, Shane. Extrinsic value. Okay, good. So when we evaluate these prices here, it is very important to understand that we are evaluating this at August 23rd expiration. So that there will be no time premium left in the short put spread. There will be no extrinsic value left in the short put spread. There will only be extrinsic value left in our long put spread. Okay, so I'm going to put a note down here. Please keep in mind that we cannot completely assess the value of the September options at the August 23rd expiration. Therefore, the values that we are calculating will be worst case scenario, which is a good thing for us, right? That's a good thing for us. So we would be evaluating this as if the September options would have no time value or extrinsic value left. That will be a good thing for us. Okay, does everybody understand that concept before we go through the calculations here? That is very, very important to understand. Now, when we're finished with this, we can go look at our model and we can extrapolate out about how much extrinsic value would be left. That'll be easy, but to do that on this spreadsheet, we really can't do that. I can add that value in after the fact once we go back to our risk graph. But for the sake of evaluating this position here at August 23rd expiration, we are going to evaluate as if everything was expiring. Okay? So, at, again, August 23rd expiration, guys. And let me see if I can actually just highlight that here, because that is really, really imperative. You know what? We'll make that font color red. Oh, maybe I can't do that. Thought I could. Oh, there we go. Okay. And maybe I'll actually boldface them as well. And I'm hoping you're all understanding also why this is so important, why I'm spending so much time on this today, more so than, you know, we normally would. Because this is really, really important to understand, circling back, why we chose to make this adjustment as opposed to just exiting out. Okay? All right. Connie, I'm asking you specifically here. What would the 287 put be worth with SPY at 277? Perfect. Okay. Pamela, what would the 284 put be worth with SPY at 277? Pamela, can you hear me? Maybe I should just ask in general to everybody. So what would the 284 put be worth with the SPY at 277? Thank you. $7. How about the 282 put? Okay, 5. And the 280 put? 3. Okay. So well, Mickey, we're only looking at the intrinsic value. So if I have a 287 strike put with the stock trading 277, it's worth $10. So on and so forth. Okay. So at a minimum, remember, I'm saying at a minimum because we're not counting in any premium that may be left in the options. At a minimum, we would make 90 cents with SPY down at 277 for our 10-cent investment. Because the value of this whole conglomeration here would be worth $1. Okay, let's go through the same numbers here. Okay, and I'll just kind of put them in and you guys can just make sure my math is correct here. Thank you, Joe, I appreciate that. Okay. And you're going to see a pattern developing here. Lyle, what talk to me. The 280 August 23rd put, if SPY is 277, wait, 284 put. Okay, now thank you. Got it. There we go. That's why I'm asking you guys to correct me here. Okay, so when I break it down like this, guys, and remember, the key to remember with this is that we're valuing this at August 23rd expiration. There still is going to be premium left in our in the September put spread. It does auto-calculate. I mean, I can add that in, Ted. I mean, but every one I do is different. Every time I use this spreadsheet, it's different. Okay. So what do we see here? What conclusions can we make from this? Okay, well, William, obviously you got it, that at August 23rd expiration, this area here is going to be our sweet spot. Okay, what else? What other conclusions can we draw from this? Well, William, if I extended this down to, let's say, even 250, it would still be the same 90-cent profit. Does everybody understand why? And I can add a column to do that. But does everybody understand why? You know, let's say SPY went down to 250. Why would the value of the spread still be $1? No. Okay, and what is the net of all the combined puts, William? Exactly. Okay, remember here, guys, we have a long $5 wide put spread and a short $4 wide put spread. So if all of the premium was taken out of the options, if there was no premium left, what would we be left with? The difference between the strikes in the 2 put spreads, which is $1. And the beauty of this is why we did this adjustment. The beauty of this is we did this for a dime, essentially a free trade. The most we could ever lose in this, even if SPY turned around and went to 300 in the next week, 2 weeks, whatever it is, the most we could lose is a dime. Okay? Now, what else? What other conclusions? What else? Think this through. And remember, I'm going to give you a hint here. Remember that these values are all based just on August 23rd expiration. So what else could happen here? Exactly, Patrick. This is a worst case. I love this scenario if this is my worst case. And we still have the September spread. So what this really does when you think about it, it allows us to have downside exposure to the market overall through SPY. Okay? And obviously we can see that because right now SPY is trading at 287. Okay? All the way up here. So we have got all of this downside exposure to make money here over the next week and a half. Remember, I say week and a half because these values are all just based on next week's expiration. Okay? We can't lose money if SPY stays here or goes down in the next week and a half. We can only make money. And on the flip side, if SPY recovers, what's going to happen? Exactly, Patrick. We're not going to lose that 10 cents. You know why? Because even if SPY is trading in this loss zone, and this would be, you know, up, so 290, 295, 300, still the same 10-cent loss. Even if it's trading up here in the next week, there is still going to be a ton of value left in our September options. So we will still be at a gain, at a winner, even though this is showing the 10-cent loss. So, circling back to the reason why I don't like adjusting, because it racks up commission costs, and when we take positions, you know, we're not investing, we're trading, and if a trade doesn't work out, okay, we close it, we move on. However, yeah, Rick, you should have that fill quite a while ago, like 20 minutes ago or so. However, there's always an exception to every rule, right? I mean, I can look back at all of the trades this year that we have done. And I'm doing that right now, and I think we've made adjustments. This may only be the second one. I think we did it on a VIX one earlier in the year, if I'm not mistaken. Oh, actually, we did one in Walmart in March. I'm looking here. and in VIX. So maybe this is the third one this year. Okay? So I'm not a fan of adjustments unless the opportunity is there. Right? Everything comes down to reward to risk. And this is about as good of reward to risk as you will ever get trading options. Okay, I know this may be a bit confusing. I'm trying to make it as clear as possible. And I'm hoping that this does that. And we will continue to monitor this. And the reason that we did this now, and somebody asked this, what benefit was there to doing it now? Why did we do it now? I mean, certainly listen, if we waited and SPY went down further, sure, we could wait, we could wait and, maybe get more. Exactly, John. Exactly. Because vol is up 20% today, which made the short put spread that we just sold more expensive. Well, Jose, honestly, I would tell you that is because I have almost 30 years experience here. So when I was looking at that partial exit signal that we put out this morning, which would have been great at $1.90, right? I mean, man, we bought this thing for $1.10. We get out at $1.90 if that's 72% overnight. Now, it's not even trading $1.90 yet. So SPY would have to go down another couple points. Okay? We could have just left that out there, taken profit, which is always a great thing to do, and then let the other half of the trade ride out. However, when I saw this opportunity, because volatility exploded so much today, and I looked at it real quick, I said, you know what? This is a no-lose situation with unbelievable upside opportunity. Good one, John. You can so here's the thing with that. And a lot of you already do this because often during the day, every single day, you guys will private message me or even throw out in the chat, hey, what do you think of this? What do you think of this? So you should be thinking about opportunities like that, guys. You should be thinking about adjustments or things that you can do, but that's why I'm here. So you can throw it out there and ask my opinion on it. But that's a good thing to start thinking about that. Raymond, that was one of the things. The increased vol accounted for about an extra 20 cents in that put spread. So if vol was where it was at yesterday, that put spread would have only been worth about 80 cents. But we were able to sell it for $1. And again, the reason why I'm spending so much time on this with you guys, and it's been like an hour, right? And I'm happy to spend more, is because this opportunity we don't see often, and I think it's such a key learning experience. And I don't expect you guys to say, okay, Scott, I've got this position. This is what I'm going to do. It's a better evaluation of adjusting this than getting out. I don't expect that out of you, and you shouldn't expect that out of yourselves. However, if I have an opportunity like this to show you something and hopefully break it down into a scenario like this that most people can understand, I want to take the time to do it. That's what you guys pay a lot of money for, and that's what I want to deliver to you guys. Okay, so again, bottom line in all of this, if we did this, so if we bought the put spread yesterday, did the hedge today, the bottom line is you have incredible upside opportunity with a maximum potential risk of 10 cents. But that risk is so minimal. If I put that risk in a percentage term, I'd say that risk of losing the 10 cents is less than probably 10%. All right, I'm going to get a drink of water, although I probably need a drink of something else, but it's a little too early in the day for that. This was all recorded. Let me get that video going here. I'll get the video posted in the room. I'll get this P&L explanation, the spreadsheet here, posted up in the room so you can have that as a resource. I know I have to update our watch list here. Oh, actually, you know what? I'm not going to end yet. I lied. Yeah, there you go, John, right? Someone said, Mickey, it may have been you. Can we see what this might be worth after August 23rd expiration? Okay, and the only caveat, there's two caveats with that, is A, you have to tell me where SPY is going to be at August 23rd expiration, so I know what that short put spread would be worth. Or B, I can just do it on our risk chart. So for instance, and here's another thing I want to say, which we didn't even get into yet. Okay, another opportunity for this. Let's say it gets to August 23rd expiration and SPY is hanging right around wherever, 284, 283, somewhere in that sweet spot. Well, we could close this thing out for this massive profit. Or what else could we do? And again, we will evaluate what's the opportunity cost there and should we make another adjustment. But what else could we do? And this is exactly the reason why I chose to do this with such a short expiration on the short put spread. So what does this allow? There you go, Glenn. If we're sitting in the sweet spot, maybe we sell another put spread, collect money, and lock in even more profits, right? Maybe at that time the best thing to do is to close it out. But it certainly gives us the option, no pun intended, and the opportunity to roll out again and see what's out there. So that was one of the other reasons why I selected next week's options as opposed to going out to August 30th or September 6th or whatever it was, because it gives us that opportunity. So much flexibility. So I guess if I was going to summarize this scenario, massive upside opportunity, incredibly small limited risk of a dime, which even that opportunity of losing the dime is so minimal. And thirdly, the opportunity to roll again, so the flexibility that this now gives us. That all went into the evaluation of why we adjusted. All right. Now I'm going to wrap this up. I'm going to get everything posted in the room. And then I'm going to come back because we have a lot of stocks to look into today. Any last questions before I turn the mic off and get this video starting to roll here? Yeah, Shane, on both ends. So yesterday when we bought the put spread, volatility was down 20% yesterday because of the big rise up in the marketplace. So we were able to buy something, albeit not cheap relative to where volatility usually trades, but just a lot cheaper than it was trading. And then the big spike up in volatility today, and obviously a downward move in SPY, allowed us to make this hedge. Merlin, if it goes to 284 today, we're gonna cheer. We're gonna get our pom poms and we're gonna cheer. Well, Julie, they're very closely correlated, but I was referring really directly to SPY. As you can see here, now, when we were evaluating this before, SPY vol was up 20% today. It's now up 28%. And Shane, you can definitely look at it this way. And Phil, it's very significant, and it was done intentionally that way. So we would still have a downside bias, a short delta bias to the spread by being long a $5 wide put spread and short a $4 wide put spread. So yes, that is very significant. All right. I'll be back in a few. Awesome, Javier. Glad to hear that. That's what you pay for. So that's what should be happening. Very, very glad to hear that.